when we're talking about paying our kids, it's income shifting. Let's say that you're in a 30% tax bracket. Your kids they're taxpayers as well. They could have a 0% tax bracket. So it's just moving money from a high income earner to a low income earner and maximizing the tax bracket. So this year, just as a single person, you can make up $10,000 tax free. A lot of people don't even realize how to understand what the spreadsheet's even saying. So in accounting, we have 3 different statements. We have a profit and loss, a balance sheet, a statement of cash flows. But most people only think about the income and expenses, basically the profit and loss statements.
When you first meet a new client, what are some of the most common mistakes that you see?
The biggest one that we see is bookkeeping, record keeping. A lot of clients just don't do it the correct way or do it at all.
Is there a difference between tax preparation and tax planning?
Let me ask you a question. When you've gone to get your taxes done, did the tax preparer ask you or give you any tax saving ideas?
Are there deductions or categories a lot of small business owners overlook frequently? Most entrepreneurs think taxes are just a cost of being successful. You work hard all year, send your numbers to your accountant, and then wait to see how big the check to the IRS is going to be. But what if the real issue isn't how much you're making? It's that nobody ever taught you how the tax system actually works. Because the truth is, the tax code is thousands of pages long, and a lot of it isn't designed to punish entrepreneurs. It's designed to reward people who are building businesses, creating jobs, and investing. Most people never learn how to use it. Today on the Gardencast, we're talking with Bryan Nelson from Real Accounting. We're diving into the biggest tax opportunities small business owners and high-income earners are missing. If you run a business, invest in real estate, or you're starting to make serious income, this episode might completely change how you think about taxes. Hey, really quick, thanks so much for listening. The purpose of this podcast is to help people understand that they have the ability to choose the direction of their life, whether that be business, finance, relationships, health, any of that. I believe that this podcast will give you the tools to take the right steps, but we need your help. Please be sure to like, to comment, to subscribe. It helps us to bring on more guests and continue to get better. Thank you so much. Thanks so much for coming on, Bryan.
Awesome. Thanks for having me. I'm excited.
This is always a fun topic, right? We just talked about taxes aren't really sexy, but saving money and not paying it is.
Exactly. So it's funny that they put the word fun in refund. So
I'm sure there's a bunch of tax jokes. Please don't hold them back. Throw out all the tax jokes. I like those. It makes it more fun. So first off, before we get into the strategies here, what are the biggest misunderstandings that entrepreneurs have about taxes?
Oh, there's just so many. A lot of times I find the biggest one is people want to start a business and people say, go set up an LLC. Well, that doesn't really mean anything to me as a tax preparer because an LLC is a chameleon type entity. It could be a sole proprietorship. It could be a partnership. An S corporation, a C corporation, and they're all taxed differently. So a lot of people don't know that.
Kind of considering that before you start it.
Yep.
When you first meet a new client, what are some of the most common mistakes that you see?
The biggest one that we see is bookkeeping, record keeping. A lot of clients just don't do it the correct way or do it at all. And so I kind of look at it as like 3 layers. When you first start, you just grab all your receipts and then you put them in an envelope. And I've had those mailed to me in boxes at year ends. And next, I feel like people then move up to an Excel where they type it in manually. And then we want to eventually get people into an accounting system like a QuickBooks Online, a Xero, something like that they're actually using a software that's tracking their income and their expenses.
Got it. Yeah, bookkeeping's, nobody likes it. It's not fun to do.
Exactly.
Right.
Because you want to go with your business. You want to go and make money with your business with what you know best and what you do. And then bookkeeping usually gets passed down to the spouse or, a girlfriend or something like that to kind of do the books and records.
To punish them.
Yeah.
You will do the bookkeeping.
Exactly. It's like your job's the books and records. My job's to go in and make money, which makes sense, right? You don't want to, if you have a high value business that you make a ton of money in, why are you wasting your time on such a low profit center in your business?
Right. I think the hardest thing too is just that it's like a different side of the brain to do that. And it just cuts everything else off. If you're like, I'm going to sit here and look at the spreadsheet. And it's hard to do sales after you're looking at a spreadsheet all day.
Yeah. A lot of people don't even realize how to understand what the spreadsheet's even saying. So in accounting, we have 3 different statements. We have a profit and loss, a balance sheet, a statement of cash flows. But most people only think about the income and expenses, basically the profit and loss statements. So.
Right. Yeah, that makes sense. So why do you think still so many entrepreneurs end up paying more taxes than they probably should?
A lot of the times it's just because they don't they don't have good books and records. So
Mm.
they make money, but then they don't keep their receipts or they don't pay for their business expenses out of their business account. And so they're just leaving money on the table.
Got it. Sometimes they'll just do like what's convenient if they're paying for something and not recognizing that that causes an issue later on when they go to
Exactly.
do
And
taxes.
they've never been taught, what is a business expense. So, we have 4 things that we look at. Number 1, does it have a business purpose? Is it ordinary? Is it necessary? And do I have the documentation? And if we meet those 4 criterias, we have a business expense.
Okay. I know some people just think everything is, right?
Yeah. Or some people think everything is.
Everything is a business expense, right?
Yeah. Yep. And a lot of people do think that.
And it's funny because on the other end, it's like I could see an argument being made for that, right? If you're an entrepreneur and you have like you might have a business and you might be like, hey, I'm going to take all of my friends and I'm going to go rent a boat in Lake Powell.
Yep.
And you're like, we're just going to go have fun. But then the reality is you end up, they're like, hey, by the way, I have this question on taxes. And then you end up getting them as a client and you're like, wait, what happened was I took them on a boat
Yep.
to Lake Powell.
Yeah.
And that was what got the client.
Yeah. And so it depends on the business. For some businesses, that might be an ordinary and necessary expense. For others, it might not be.
Yeah.
For me, I look at it, for me to take a bunch of friends out on a boat, probably not really a deductible expense, but I see people that are
myself invited on.
Yeah, exactly.
Go ahead.
But you see people like, I don't know, I see it a lot in the door-to-door space where they're doing a lot of recruiting and things like that. So maybe, we can make an argument that would be an ordinary necessary expense.
How about if you own a mortgage company?
Hey, we'd really have to break it down, So for everyone, it could be a little bit different, but almost anything can be a deduction if it meets those criteria.
It's just got to make sense. Like you've got to be able to justify it.
Yep.
And like, what are the odds? And I don't know if you noticed or not, but what are the odds of getting audited with stuff like that?
Depends. So I saw someone post on Facebook. They're looking for a tax preparer that's really good with Schedule C's and losses. Well, to me, that jumped out as high audit risk right there.
Okay.
So anytime you're a Schedule C, your audit rate just went up. Because when we go back to our financial statements, profit, loss, and balance sheet, when you're a sole proprietorship, you don't have to have the balance sheet, only the profit and loss statement.
Okay.
But it's easy to go into your tax software and just put whatever numbers you want to make the refund be what you want it to be. But if you're doing accurate bookkeeping, profit, loss, and balance sheet, which you'd have to report those on a partnership, a corporation, S corporation return, then it eliminates a lot of that high audit risk that you have.
So better to have the LLC in the book set up rather than doing it as a Schedule C.
Yep. So anytime I see Schedule C, we try to move them out of Schedule C's as quick as possible.
Okay.
Because it's auditable because it can put you into certain credits. So let's say like an earned income tax credit, that could get you almost a $9,000 refund. So why wouldn't you cheat on your taxes if you're a Schedule C?
Okay.
Right. And so the IRS knows that. They see the data. It's not that hard for them, especially with AI that's coming out, to look at one line item on your tax return. And they're looking at those things like entertainment, travel, meals. Those are going to be the ones that need different documentation.
Okay.
Because if I was going to cheat on my taxes, that's probably where I would be manipulating my numbers.
Okay.
And so in those types of expenses, then we kind of want to have the W's, the who, what, when, why, and where did I have that expense? And now I have a logbook of those expenses that I could then show to the IRS.
Okay. Does anybody keep logbooks?
No. Very, very.
You should, right? I mean, you only need them in the event of an audit, but if you do, I mean, it's.
But yeah, if you're ever audited, the IRS would say, show me your books or your logbook. And they would see that you made it up over the weekend. And so, it's best to, just kind of keep a calendar of your day. What are you doing on a daily basis? Where did you go? Why did you go? And start to document those items that would be a higher risk area of the tax return.
Okay. That might be helpful. So if I don't necessarily create a logbook, if I've got it on my calendar, at least have something that I can reference.
Yeah. But you're never going to get audited if you're showing income, right? The more income you show, the IRS is happy if you're cutting them a check. So whenever you see big losses or certain types of return forms on a return, that's where the audits happen.
Okay. That makes sense. Okay. Yeah, I like that. So is there a difference between like tax preparation and tax planning? Are they similar? I don't know why when I was doing some research, but it was just like there's a difference. I'm like, well, is this tax prep like we're actually getting it done, or is it more like are we planning ahead, or are we being like proactive versus reactive? I guess is
Yeah.
probably what those two things are.
Yes. Let me ask you a question. When you've gone to get your taxes done,
Mm-hmm.
did the tax preparer ask you or give you any tax saving ideas?
0.
Yeah. So that's your tax preparation right there. It's all about, we have 100 days to get through all the tax returns that we have to prepare for the year. You're going to be in and out. See you. Bye-bye. See you next year.
Okay.
Okay. Tax planning is you're actually going to meet with your, I call it tax strategists. You're going to meet with them as often as you can be. Because what you want to do is you want to build your team around your tax professional. They kind of lead you in a lot of different areas in growing your wealth.
Okay.
And so we have clients that we meet with one time a year. We have clients that meet with us on a monthly basis.
Mm-hmm.
It costs money to meet with me on a monthly basis. But who generates the most wealth, who generates the most tax saving is the guy that you're talking to more often.
Got it.
Because if you only come to me once a year, I don't even know if you're coming back the next year.
Mm-hmm.
Like you haven't talked to me for a year. I really don't know if you're coming back or not.
Right.
If I talk to you every single month, we're building wealth strategies, tax strategies, then we know we have a working relationship.
How long are those when you meet with them once a month? How long does that typically take? Is it fairly short?
Yeah. I mean, we usually schedule an hour. It might take 30 minutes.
Okay. And we're just like, let's make sure that we have a good game plan going so we can have as little of a check as possible.
Exactly. So what we have to do is we have to get to know what our clients really, what are they trying to accomplish? So we have a wealth and tax strategy that we put clients through, that we have a kind of a system and a plan to put you through step by step. By the time you go through that system with us, then you're growing your wealth, you're saving taxes. And so that's the difference between a tax preparer. Tax preparer is never going to ask you really what you're trying to accomplish. They just want they just want your tax documents now.
That makes sense.
Get it into the system, tell you if you owe, if you have a refund. And what's crazy is most of the time you don't even know what's on your tax return. You take your paperwork to a tax preparer, and then they just come back to you and say you got a $3,000 refund or you owe $5,000. But you really don't even understand the tax forms itself.
Sometimes I feel like I give it there and they hit the print button and then say, here you go.
Yeah.
And I'm like, I could have probably done that part.
Yeah. Yeah.
But I don't know what it is. I don't know what exactly happens, behind the scene.
Yep.
And then just to what you said there, I've noticed that I think it makes a big difference if an entrepreneur has a good understanding of the tax code, because it seems like some tax preparers I don't know if they're just printing it or what. So I've got to bring something to them like, hey, what about this? Hey, what about that? What about,
Yeah. A lot of times you bring an idea to your tax preparer and they don't want to, they've already done the tax return. So they don't want to go back and make more work for themselves to now talk about strategy. You could have written this off, could have written that off. So I've had a client that was with me for a long time and then they left me, they went to another preparer. And then just this week, they called back. And because, the tax preparer that they went to last year, they got a big refund. This year they owed. And it's just like you owe, but they didn't go over why you owe. It could have been multiple parts of the tax return that caused them to owe.
Yeah.
But when we started to look at it, just the books and the records weren't right. So, and sometimes you can't always blame the preparer.
Yeah.
Because it's up to the client to bring the correct information to the tax preparer.
That makes sense.
But if you only talk to your client or your tax preparer one time a year and they never advise you, you really don't know what you can do. Like you mentioned in the opening, the tax code is tens of thousands of pages long, probably 70,000 pages. And the first maybe 10 are what's taxable income. The rest is how to get out of taxes. And so you never get that explanation of how to get out of taxes.
Mm-hmm. Okay, that makes sense. For someone running a small business, what are some areas of the tax code that people should at least be aware of?
Yeah. The different types of taxes that you would have.
Okay.
So when I'm doing a tax return, you have federal tax, you have state tax. Maybe you don't if you live in certain states, but you have FICA, which is Social Security and Medicare tax.
Mm-hmm.
When you start to add up all those taxes, so let's just say you're a W-2 employee, you take your first job at McDonald's, you thought you were going to get $100, and then when you get your check, it's $80, right? It's because the taxes are already being withheld out of your paycheck.
I love, just a side note really quick, I love like new employees, like when they're, they're like waiting for their $100.
Yeah.
And then you pay them and they're like,
Yeah.
where's the rest of my money? Did you take it?
Yeah. And they think you shorted them
Welcome to
money.
being an adult.
Yep. But no one's ever taught them, it goes back to financial education. It's just really never taught, especially as we're, K through 12, you don't get taught financial education.
Got it. What do you think about for the small businesses? I mean, one of the things that I had learned is the difference between, doing the S corp.
Yep.
And can you talk a little bit about that and like when, what it is for those who aren't aware of it, and what it does and how it saves you?
Yeah, there's different types of taxes and there's different types of income as well.
Okay.
And so you have ordinary income, you have portfolio income, you have passive income. That's why I like to go over what's on the tax return with my clients so they understand what bucket the income's coming into.
Yeah.
And so they're all taxed differently. So if we just we're a sole proprietorship, a Schedule C, then whatever our net income is, we owe federal tax, Social Security, Medicare, and state tax. Okay. If I make that S corp election, now all my income is only subject to federal tax and state tax. So I eliminate Social Security and Medicare tax.
Okay.
But the catch is the IRS says you need to pay yourself a reasonable salary.
Okay.
Because they want some Social Security and Medicare tax. But by just making that election, your tax savings could be tens of thousands of dollars a year just by making that one S election. Telling the IRS, I want to be taxed as a subchapter or an S corporation.
And that's something that the tax preparer does to file that as an S, or is that?
Yeah. Okay. So I would never make that unless I went through a tax professional that helped me make that election with the IRS.
Okay.
So these things that I teach, it's never something that you should DIY.
Yeah.
It's just, it's the most expensive probably words in the English dictionary, I think. And I'm the same way. I try to DIY things myself. And when I start to do those things, I realize I'd just be better off having a professional do it.
Yeah. Especially with something like this, you run the risk of causing so many other problems, and those are way more.
Yep. And one thing that came up this week is a client has an S corporation. They went to some mastermind. And they said, you're an S corporation. You should be paying yourself a salary, that reasonable compensation. But sometimes you don't have to.
Oh, really?
Because if I'm a business, I'm not profitable. I'm not taking any money out of my business yet. Then the IRS doesn't require you to pay yourself a salary. Because all you'd be doing is borrowing money, loaning it to the corporation to pay yourself a salary. So as long as you're not taking out distributions, is what we call them, or what you'd say a dividend into the C corporation, then it could be too early to be paying yourself a reasonable salary. So we really have to monitor that. Is it too low? Is it too high as we're working on tax returns?
Got it. Are there deductions or categories a lot of small business owners overlook frequently?
Yeah. I mean, the tax code has so many deductions. But what's funny is I've been doing tax strategy calls pretty much nonstop since Corona time, was that 2021? And it's funny because clients just don't know what to ask. So the questions I get asked are all the low hanging fruit. I think we talked to them here just shortly before we started. Paying your kids, that's one.
Okay.
Because that's what they see on TikTok. Maybe buying a car. Those are the low hanging fruits that everyone's going to tell you you can do. But
can you explain those ones really quick too, just for those who don't know that strategy?
Yeah. So what we're looking at when we're talking about paying our kids is it's income shifting. So let's say that you're in a 30% tax bracket. Your kids they're taxpayers as well. They could have a 0% tax bracket. So it's just moving money from a high income earner to a low income earner and maximizing the tax brackets. So this year, just as a single person, you can make up to $15,000. Not the exact number, but basically $15,000 tax free. And everyone has that. So the first $15,000 that you're out there earning money on as a single person is $15,000.
Okay.
Goes up to $31,000 as a married couple.
Okay.
And so everyone has tax brackets. So my daughter's with me today, so she has a tax bracket. My parents have a tax bracket, and so not only can we pay our kids, we could also maybe even pay our parents. So it's just figuring out, and that's what a strategist does. They look at maybe in your family situation, see who can file a tax returns and where can we maximize those deductions. So
do the kids have to be doing something, or how does that work if it's an audit?
Yep, has to be reasonable pay for reasonable work.
Okay.
So you can't just pay your kids and they don't do anything for the business.
Got it.
That would be an area where if you ever were audited, they would, disallow that deduction and charge you interest and penalties.
Mm.
And then it also is based on age and what entity you're paying them out of. Like all those things can come into play that you kind of suit yourself and think you're doing it the right way.
So can they earn 15,000 tax free? Okay.
Yep.
So if they're doing stuff with me on videos or whatever, and I've got them on there, I can pay them to do that stuff.
Exactly.
And then they can pay me rent for living there.
Yeah, exactly. Yeah. So that's, so the way
she's shaking her head like, yeah, that's her.
Yeah. So the way I look at it is, if I'm going to be paying my kids for their work, I still have to provide them with housing and food, those items, but they can use that money for anything extracurricular that you may be paying for already. So I have a boy in basketball. I have a girl that was in dance. Well, I got to pay those things anyway. Why not have them come work for the business? They get a paycheck. And so I get tax savings, and then they're going to use that money to pay for their extracurricular activities.
Got it. Does that paycheck have to run through the payroll system, or can they get 1099 or?
Yeah. So it comes back to what entity you're paying it out of.
Okay.
And that's probably the main one. And then how old they are. So when they're younger, we will use just a LLC that's a sole proprietorship typically for that. Because if I pay them out of an S corporation, I still pay all my Social Security and Medicare taxes. If I run it through a family management company that I set up as a Schedule C, I move my money from an S corp to the Schedule C, and then I pay my kids. So it's one extra step. But by doing that, I save the Social Security and Medicare tax, which is another 15.3%.
I like that. So I want to walk her through that again. So if I have my S corp, and there's a sole proprietor or a Schedule C under that.
So we can just call that a family management company.
Okay, family management company. So that gets paid from the S corp.
So the S corp pays the family management company for the kid doing work for the S corp, and then you take money out of the family management company to the kids, and then they can spend the money how they like.
And then they can pay for their own baseball and which my kids' sports are a lot throughout the year. So I've never known that one. So that itself makes this worth it. Okay.
If you pay them directly out of the S corp, then you're not getting your full deduction. So you want to just make sure you add that next layer in there to get that real tax savings.
Okay. Got it. I like that. Okay. So that's one. Any others you can think of that a lot of small business owners overlook?
Oh, there's so many. I mean, where do you want to start? Home office is always a big one.
Okay.
I always like to jam on that one just for a little bit because there's two different ways to do it.
I just want to learn. I want to learn more of this stuff. So yes, please tell me.
Yes, there's a lot of times the IRS says, hey, there's a standard rate to do it, and then there's an actual rate to do it.
Okay.
So home office, let's say that for some people, it might be an administrative home office because it might just be a place where you go and do work outside of your real location. Because your real location, say it's like a doctor. He doesn't really have a place to sit down and do work, so he has to set up an admin office, okay? So the quick, dirty, easy, simple way that a tax preparer will do your tax return is you get a maximum of 300 feet times $500, or $5 is a $1,500 tax deduction. So quick and easy, you save $1,500. Well, not save $1,500, it's a $1,500 deduction, okay? Or we go to the actual, and we break down what's the real percentage of my home office compared to the rest of my house.
Okay.
And if we really look at the actual, I might be able to get a $9,000 or $10,000 deduction because I actually went through and calculated a higher percentage. So let's say I have a 4-bedroom house, just make it simple. I use 1 bedroom for the home office. Now I have a 25% of my mortgage interest, my property taxes, my utilities, all these things that add up. I get 25% of that cost on an annual basis.
Oh, wow. Okay.
So, which is going to be substantially more than $1,500.
For sure. So on those, do I pay the utilities out of the business, or I should pay them personally, and then I just get the records and like, hey, here's what it was for the personal?
So this is on a tax return. So let's just say you're a sole proprietorship. You fill out a Schedule C. You also have to fill out a Form 8829, which is the home office form.
Okay.
And so the IRS sees both the Form 8829 and your Schedule C.
Okay.
And so what we like to do is what we set everyone up as an S corporation. Now you're an employee of the business. And so the S corporation needs to reimburse you individually for that use of your home office.
Mm.
And so what it is, we call it an accountable plan that you set up to get reimbursed.
Okay.
So what I like people to do is still pay for all those expenses personally,
Mhm.
and then they get reimbursed for the business for the use of the home office.
Okay. And you just do that at the end of the year or something like that? Is that how you
Just
do
a
it?
quick year-end adjustment.
Okay. Wow. Okay. I like that one. That's a
So
good one.
that's one where you need to really understand if you're an S corporation is accountable plan,
Yes.
because that's the things that, so when we're talking about, doing taxes, we have some items that we pay 100% for business. We have some items that we pay for during the year that are 100% personal.
Mm-hmm.
And then there's those things that are kind of that hybrid.
Right.
So in the homes and the being used for the business, it's a hybrid. So that's where we utilize the accountable plan just to reimburse ourselves, and that's tax free. So when we reimburse ourselves from the corporation to us individually, it's
Mhm.
tax free.
Okay. I like that. And I don't know if that's something I've been doing either. So I appreciate that. That's a good one there.
Yep.
I wanted to talk a little bit about so I do a lot with real estate investors, right? Both from my mortgage company, and then just from the real estate investment group that I'm part of. And so we hear a lot about the bonus depreciation when somebody's buying, a property. I don't know if it's for nightly rentals or what, but can you talk a little bit about that and how that works and how we save money, how the investors save money with that?
Yeah, this is an area that can be overpitched for people on tax savings.
Okay.
Because when you're a real estate investor, we have that bucket of income that's passive income. And so if we ever have passive losses, so if I'm just a passive investor in a real estate project,
Mhm.
the real estate project does bonus depreciation, has this big loss. When I go to do my individual tax return, I have big losses, but the IRS can make it to where those losses don't flow through to offset my other income.
Okay.
And so there's so many factors that come into this. And that's why I say when you want to start looking at bonus depreciation, make sure you're working with a tax professional, because a lot of times you'll be sold on these things that might not work for your taxes in year one.
Okay.
Okay. So we have our different buckets. So we have ordinary, portfolio, and passive. So real estate investing per se is passive income.
Okay.
Okay. Because we're not doing anything. It's just based on time. You're hopefully buying a piece of real estate and it's just collecting you a check every single month.
Mhm.
Okay. So the way that the real estate losses work, if I buy a rental property and my taxable income is 100,000 and below, I can actually write off $25,000 against my income up to.
Okay.
Okay. My income's 100,000 to $150,000. That $25,000 starts to phase out. So when I'm at 150,000, if I have passive losses, they all get suspended and I'm not able to save taxes on my tax return.
Mm.
Okay. So there's loopholes to get around that. You probably heard the word real estate professional status
Yeah.
or Airbnb. Those
Mhm.
are the two ways to get around those suspended passive losses. Okay. So a lot of times people will make investments into these properties, these real estate, developments, and they're thinking they're going to get all these losses, but they get suspended. So the way to unlock those suspended losses is you need to generate passive income. So passive losses can only offset passive income.
Well, okay.
So it gets really complex. Like we probably would need even more time on this to go over all the details, but it's something that you don't want to work with alone, something you'd never do yourself, but you need to work with a tax strategist like myself to see if those would even benefit you. And if they
Yeah.
don't benefit you, how do we make it benefit?
Yeah.
So
So is that like somebody that has, maybe they make 300 or 400,000 and they're W-2 and they're thinking, well, maybe I can go buy an Airbnb and get a big, the deduction on it. What you're saying is, well, it doesn't work that way.
yeah, it's not that easy.
It won't offset that income. It will offset passive income.
Yeah, so with Airbnb, it's a little bit different because if we're an Airbnb, there's certain rules in the tax law that want to prevent us from taking those big losses up front.
Okay.
And so with an Airbnb, it's more of an active business because you're treated more like a hotel. But the catch in there is the IRS says you have to actually materially participate in the Airbnb activity.
Okay.
So if I buy an Airbnb, I have a property manager that's in there doing all the bookings, and then I have cleaners that are going in and doing all the cleaning. They might put more hours into the real estate than I do, which could prevent you from getting those losses. And so that's where we have to work with our clients and say, okay, we have to make sure we're meeting these tests. Are we meeting the material participation test? Which there's 7 different steps in there that we have to meet one of those 7 tests. If we do, then we're able to unlock all those losses from the phantom expenses of depreciation.
So does that change it then from passive income to I have a business?
Yep. So from passive to active. Yep.
To active. Okay.
Yep. Or the other way is to be if you're a busy professional, you're making a lot of money, but your spouse is at home and she's really not doing anything, then we try to make her qualify for a real estate professional status.
Okay.
So what that is it's 750 hours in a real estate trade or business. And you have to have more hours in real estate than any other activities. And you have to materially participate in your properties. And so there's different tests that we have to make sure that we're qualifying for. And then once we can qualify for that, then it can unlock all those losses from real estate that you can use to offset your W-2 income.
Okay.
So
and in that case, are you able to take any of that bonus depreciation and
so
offset
in that
then?
case, you'd be able to take all that bonus depreciation, offset your W-2 income, and lower your tax bill. So
okay. Sounds like you kind of have to be proactive about that before you buy something.
Super
you can't
proactive.
just buy it and then be like, oh, hey, why don't I get this big deduction?
Yeah, and people mess up all the time. So that real estate professional status, if we don't meet that, we fail. If we do meet it, it's going to be a high audit risk area because the IRS is going to see big losses flowing through, offsetting your active income. And so you want to make sure that you need to keep a logbook of your hours to prove that you were spending time in your real estate activities.
And is that where the 750 hours comes into play?
Yep. So it's always best for a professional. Let's say you're a high earning doctor. Your best place to bet is a real estate agent because now that real estate agent's brokerage is one of those activities that would qualify. So if I'm a realtor and I'm spending 750 hours a year doing my real estate listings, showing houses to buyers, and 50% of my time is more than any W-2 that I'd have, which you would be. So you'd be 100% realtor. And then we materially participate. We're managing our own properties. Now we open up the world to bonus depreciation, offsetting all that W-2 income.
Okay.
So a doctor would generate.
So that would be an advantage for, okay, maybe I'm not understanding that correctly. How do the doctor and realtor?
They should connect.
Okay.
Because the doctor's earning ordinary income.
Right.
Okay. If we're in real estate losses, then we can't take those passive losses to offset our doctor income.
Right.
Okay? Now my spouse, she goes to work as a realtor, spends 750 hours selling real estate. Okay. The majority of her time is in real estate versus anything else that she does as far as work.
Okay.
So maybe she's teaching gym lessons 1 hour a week. Okay. She has to have more time as a realtor than teaching gym. Okay. And then you have to materially participate. So you actually have to be managing your real estate portfolio. Okay. You can't just hand it off to a property manager. You want to have your wife actively involved in managing the property. Now, with that real estate professional status, we can unlock all those losses because we're real estate professional status and offset our W-2 income.
So even if she made zero money doing real estate, as long as she's spending that time, then it unlocks that.
Yeah, but we'd want her to make money. Like if you're out there spending 750 hours,
I mean, ideally you might make
you should make money,
something,
right?
But
yeah,
but if you didn't, and you had that 750 hours or something, that's part of the qualification to.
That's where you have to be careful. The IRS is going to want to see your logbook, and so you can't just hop on Zillow for 8 hours a day and never buy a property, never list a property, never take buyers out because you really didn't do anything. You just looked at Zillow all day.
Yeah.
So you really want to make sure that you're crossing your T's, dotting your I's, but actually try to make money in it, which is okay because you can make that money and then turn around and invest it in real estate to get that bonus depreciation.
Oh, right. Love that.
So, and I know it's a complex area, so it's these things that we have to talk about over and over with clients before it clicks. And I like to draw it out for them, which is easier to kind of understand.
Yeah.
But a lot of times you'll hop on TikTok and you'll see, hey, just go invest in real estate, get the bonus depreciation, you get those losses. But then when you go to the tax preparer, one that's competent and understands the rules around it, they might say, hey, those losses are suspended. They're going to sit there until you have passive income from the investment.
So that would be a problem if you just went and bought, but weren't proactive about learning this and making sure you got those things in place.
Yep.
So if you're going to be buying an Airbnb in the future,
Yeah, you want to make sure
you understand this thing so you can plan it up front. And it probably won't take very long to plan, but just so you understand, like, okay, we need to get this set up and this set up and this set up before we go out and buy.
Yes. Yep.
Okay.
But the bonus depreciation, let's kind of go back to that. So what it is.
Yeah.
So if I go on, let's say I buy a piece of property. So the IRS has different tables for the class life of how we should write it off. So a lot of times, I'll have clients that come to me and they say, hey, I spent $200,000. I bought a rental property. Well, you don't get to write off that full $200,000 in year one because the IRS says, hey, if I buy a residential rental, I have to write that off over 27.5 years.
Right.
So that's how long they think that the property is going to last, right? But the land never wears out, so that part never depreciates. So we always have to separate out the structure from the land. Okay. So a quick and easy would be, if you go to most tax preparers, they're going to say 80% building, 20% land. I'm going to write off the 80%. Okay. So that's going to be written off over 27.5 years. So how do I speed it up? That's by using bonus depreciation. Okay. So what you want to do is you want to have a cost segregation study performed. That's typically done with a CPA and an engineer. And so they're actually going to go out to the property. So let's look in here right now. We have the structure itself, that's 27.5 life, but we have lighting, we have plumbing, we have carpet, we have windows. All those things can be separated out into shorter class lives.
Okay.
So how long does carpet last? 5 years? Not a long time. And so the IRS says, hey, we can have that study performed and we're going to break out the carpet that should be written off over 5 years. Okay. Some items will be 7, some items will be 15. Some items will be 27.5. But the way bonus depreciation works is anything that's 15 years or less, we can speed up and write off in year one. Okay. So we're going to have a big chunk that we write off in year one. The other part's still going to be written off over 27.5 years. Okay. But it's going to be a big deduction up front to get that. And so we like to work with our clients because if you speed it up 1 year, now we get a tax refund back. We want you to take that tax refund and buy property number 2. Okay. Because now the government's subsidizing part of your down payment on the next one. Right. And so bonus depreciation, I don't really think it's a one-time thing. I want you to have a strategy of buying multiple properties.
Right. That makes sense. And how much does the cost segregation cost typically?
So it depends on the size. Typically, we have a really good company that we work with. What's cool with most cost segregation companies is we can send them over the data. They'll do a free analysis for you of what they think the components would break out to. And then I look at it, okay, your tax rate is X. So this will save you X amount of dollars. It's going to cost you this much. And so if I ever send you to a cost segregation specialist, I want to make sure you're getting a return on your investment by using them. The same thing with me. Like, I don't want you to spend me and I'm not making you a return on your investment. And so, but typically the ones I see are right around $3,000 for single family homes. Okay. It can go up more if it's, commercial buildings and things like that.
But you get to move all that stuff to depreciating it or to tax savings now. So that seems like for the real estate professionals, real estate agents and other who are full-time real estate investors, it can be just a huge advantage for them if they meet that criteria of a real estate professional. And then they're buying an Airbnb and it's a business.
So you don't have to be a real estate professional to buy Airbnb. All you have to do is buy the Airbnb. You just have to materially participate. So you just have to spend more hours. So is
that in order to unlock the bonus depreciation, you have to materially for that. Okay. How long do you have to spend on that?
So there's 7 different tests that we have to look at to see if we can qualify for one of them. The golden one is if I spend 500 hours a year on my Airbnb, then all of my losses from the depreciation will count. Okay.
Okay.
Or that could be 100 hours and I do substantially all the work, or I do 100 hours, but more than anyone else. So let's say that I spend less than 500 hours, but I have cleaners that are in there spending more time than me. I could fail that test.
Okay.
So the goal is to actually, buy the Airbnb and you're going to be involved in managing it.
Okay. So you don't necessarily need to have 700 hours, but that's where before you buy it, if you have a plan up front with whatever, maybe it's you're managing it yourself. And so you're going to spend the 100 hours.
Yep.
And you're cleaning it or whatever.
Yep.
Hopefully the people don't do that. But if
Yep.
you do,
Yep.
and that qualifies, then you can still take that bonus depreciation.
Yeah. Yep.
Not having to be a real estate professional with the 750 hour type thing.
Yep. Yeah. So you kind of got to separate Airbnb versus just a traditional long-term rental. And so with the Airbnb, what you have to be careful too is the average stay has to be 7 days or less to qualify. So let's say that someone was staying in that Airbnb for 30 days. That might disqualify it because you haven't met 7 days or less. So we have to look at how many bookings did you have, how many people stayed. We got to make sure that average stay is 7 days or less.
Okay. Interesting.
But if you look at most, Airbnbs, the average stay is probably three days.
Yeah, we just had an event yesterday where we had a bunch of people that manage those, and that was what they were saying, about 3 or 4 days is typically what the average is.
Yep.
So
there's just so many things that, we just want to make sure we're being super careful. We're meeting the criteria. We're doing logbooks of our hours so that when that does come up as an audit, we can produce the documentation to show that we did spend the time in the activity. So
are there apps or anything that can be used for that as logbooks, or is it just like old school here?
That's what everyone asks. There's nothing that, I like to just use calendars, maybe Excel, The IRS, so even on that 750-hour test, you don't want to stop at 750 hours. Because what if the IRS disallowed 1 hour? Now you're at 749 hours. Now we failed. And so, we want to get as many hours as we can in that activity just to make sure that we're covered.
Right.
But these are all things that you got to have a professional that understands all these things. Because if you just mess up in one area, it could cost you, the tax savings.
Right.
So
yeah, I don't want that. Are there situations where real estate investors actually increase their tax bill because they didn't plan ahead?
Yeah, because look at depreciation. It's the key of real estate investing right there.
Yeah.
So yeah, that's a big one. You just really got to plan. And when we're doing tax returns, we're looking at current year, but we're also looking at future year.
Okay.
So let's say that you go and you buy an Airbnb or you invest in real estate, but you really don't have high income. Maybe it's not the time to really speed up that depreciation. So we got to look at things down the road. So I try to look at things kind of on a 5-year scope and try to map it out when you'd get the best tax savings.
Got it. So can you take that bonus depreciation in year 2 instead of year 1?
So you could hold off on that cost segregation study and do it 2 or 3 years down the road.
Okay.
So
if the year you buy it, you get taxable income is a little bit lower. Then okay, it may not make sense this year, but next year I've got something coming in.
Yeah, got more money coming in year 2. Okay, now we can do that cost segregation study.
Okay.
And just catch up on that depreciation at that time. So
does it matter how you buy that property, whether it's like traditionally or through like a seller finance or anything, or does like the amount you put down, any of that matter?
So you just really want to be super careful on that. You want to make sure that you own title to the property.
Okay.
If you don't, then it's not yours to depreciate out.
Okay. Sometimes you might, a real estate investor might negotiate a deal on a seller finance where maybe they're not putting hardly any money in to acquire the property.
Yep.
But that part doesn't matter.
No.
Okay.
You can put down as little as you want.
Okay.
So, but yeah, the IRS doesn't look at your payments or what you put down. It's just the cost of the property itself, and then depreciating that out.
Okay. Love that. Okay. I'm going to have more questions for you at another time.
Yeah. That's where people really messed up on bookkeeping, is because, it's not what you pay. So you might put $100,000 down on a property and think that you get to write off that 100,000.
Right.
But you're still limited to 27.5-year class life on the depreciation unless you do that cost segregation study. And so you want to make sure that you're working with someone that understands accounting and taxes,
Mm-hmm.
because you might be thinking you're getting a bigger deduction than what you actually are based on how you structured everything.
Okay. So what do you typically see when you do the cost segregation? And this might be a hard one to answer. If the building's worth 100,000, right? How much of that do you usually see that you can use in bonus depreciation to write off year one, as opposed to the 27.5?
They're probably around 30%.
About 30%. Okay.
Mhm.
So if I buy a house that's maybe 500, and let's say 100 of that's land and 400 of it's house, then I might be able to take the 100 or a little over 100
Yep.
and deduct that in year one.
Yep.
And then I should have used 400 as an example. That'd be way better, huh?
Easier
Let's redo that. Eugene can leave that in, but we'll redo it. So if I buy one for 400 and 100 of it's land and 300 of it is for the building, then I can potentially take a deduction for the 100. That's going to be the bonus, and then the remaining 200 would be distributed over the 27.5 years.
Exactly. Yep. You're getting it.
Okay, I got it.
Yep.
I got it. Okay, good. Especially when I redid the math at 400.
Yeah, and it depends on who does the cost segregation study. A professional one might be able to get that higher. There's DIYs out there. I just wouldn't recommend doing it, just because they're not going to be able to get it as detailed as you need it to be.
Okay.
Plus, like when I go to a specialist that does cost segregation, I'm gonna get a nice size report of what they did.
Mm-hmm.
I've had clients do DIY and it's a 2-page paper. Like, it's just not gonna hold up if you're ever audited on that. So
is there a price range of home where like it just doesn't make sense? Because I'm thinking like, hey, like I have some people who are buying homes and investors buying homes in Oklahoma for 70 grand.
Yeah, might not be worth it.
Yeah, might not be worth it then for 3,000. What price range are you thinking? Like, hey, if you're above this, it might make sense.
I don't know. I always want to look at the situation to see, but definitely 70,000. I'm probably under 100,000 is probably too low. But if I'm getting up to probably 300,000-400,000, I'd probably start looking at it.
Okay. And then of course above that's gonna,
I
mean, there's some like I know there's some Airbnb style homes that are several $1 million, and
and so then it comes down to what's your tax situation. If you're buying $1 million Airbnb, and I only have $100,000, $200,000 in income, it might not be worth doing bonus depreciation all up front right now.
Mm-hmm.
So everything needs to be looked at.
Okay, got it. I'm thinking of, I have somebody that looking at buying one that's in the $3 million range, right? And they've got great income as well, W-2 income, but strategizing. Okay, how do we cost segregation this, or do the cost segregation on this one and deduct a lot of that in year one? Like that would make a big difference for them.
Yeah. Yep. You got to be careful. If you're bringing in partners, then it comes into, okay, is your partner putting in more time than I am? Does that affect those material participation hours as well? So we have to look at all that.
Okay. It's all good things. So it's better just get with you, like, here's what we're going to do. Here's our plan. Give me the cheat sheet so I make sure that I follow it.
Yep.
I log whatever I need to.
Yep.
And then when it comes time to file, then we know we've done it right and we don't have anything to worry about. Yep. As opposed to like being reactive, like, hey, I already bought this place.
Yeah, it's like I already bought it.
I bought it last year.
I thought I was gonna say
it's April 14th now.
Yep. Yep.
You never get those right.
Exactly. And what's cool with certain strategies is, we're filing taxes in April, but a cost segregation study, I have all the way till October to do that study for 2025 taxes. And so there's some things that expire at year end you have to complete. Some things you have to have completed by April 15th, say like a traditional IRA. But a cost segregation study, we could wait all the way till April 14th, have that study done for our 2025 taxes. So it's still things that as I'm preparing returns, I look at to see if it makes sense doing.
If you do that bonus depreciation loss, can you carry that back?
No.
Okay.
No. It can be as the year.
Okay.
Year of.
Got it for that year. I was thinking about it because I had a client who was buying one, and it just didn't get done on December 31st. It got done a few days later. Like, I was totally bummed, and it was,
But you might, but it comes down, was that for 2025 or? Yeah. So he'd still have all the way to October 26th of this year to do the bonus depreciation for last year.
But he wasn't on title for December 31st.
Yeah.
It didn't go on title until like January 5th.
Okay. Yeah. That's going to push him to the next year.
Yeah. And he had a good income year that year, not as much this year, but a good income year that year. So he was trying to offset it.
Yeah.
And
that's where timing always matters. So
yeah,
a lot of the year-end stuff is so hard to do because, yeah, you just don't know those exact situations. So
there's so many things that come up that cause delays, I feel like, at the very end of the year because everybody's trying to get so many things done, right? And that's
yeah,
kind of what it is. So it's
yeah,
better to be
yeah,
early.
yeah. So if I were a client that's selling a piece of real estate, I'd rather have them do it January 1st rather than December 15th because if you sell a property in January 1st, I have all year to strategize for you, right?
Mm,
But if we sell something December 15th, now we only have 15 days to plan. That's why it's important to have a tax strategist on your team.
nobody
So they
buys
don't
on
get
December for 15th, so that
yeah,
kind of
you know
solves
that.
that.
Yeah, you know more on that end than I would, right?
I know, yeah.
But
Nobody buys then, so that's okay.
you get the
But
point,
yeah, I
right,
get,
Dad?
yeah.
Yeah.
I guess except for he was buying, so and it didn't quite work out for December.
Yep.
Yeah. Okay. I love that. I mean, those 3 strategies right there are just so big for real estate investors and entrepreneurs, and some that there's a couple of them that I've used and some that I haven't. And it's like, I think if you have a good understanding of how that works, then at least you can be a little more clear about your preparation for it,
Yeah.
or I guess planning, right?
Yeah.
Not planning, not preparation,
Yep.
planning, and then just being able to communicate that to whoever is doing the taxes.
Yeah.
And but if you're doing those complex strategies, because I've found that there's different levels of people who do what you do, right?
Yeah.
There's some that just seem to hit print, but don't really know any of it, don't really offer anything, don't really plan, don't really, anything. And then there's the other extreme, which I've used in the past as well, which is like these big companies that like charge you a fortune for every minute that you're talking to them about anything, and they have this whole team and they charge you for every minute of all of them. And so you've got to kind of figure out where you're at, and
Yep.
find something that's going to fit for
For
what you're
you.
doing,
Yeah.
right?
Yeah. It's different levels for sure. Based on income. We moved away from just doing the typical W-2 employee tax return. So in order to be a client with us going forward, you either have to invest in real estate or own a business because we can do a lot of tax savings for you in those areas.
Mm-hmm.
If you're a W-2, even if you're a high W-2 earner, we have real estate professional status that we could use. But outside of that, it's really a 401k and HSA. There's really not a lot of strategy around those types of tax returns.
Okay.
But yeah, you get into the business and real estate world, it's more than just those items. I mean, we put you through a list of things that you can deduct and make sure that you're deducting them.
Mm-hmm.
And then making sure that those deductions are in your financial statements as well. It all comes down to what type of income are you earning because they're all taxed differently.
Right.
A W-2 is taxed differently than a Schedule C. Rental income's taxed different.
Mm-hmm.
Short-term capital gains, long-term capital gains, royalties, all these things are taxed differently. So we have to know what type of income we're earning and then strategize around that.
Okay. So for most of the people that are W-2, is it just, there's a lot of just software? Is it, you think it's easier for them to just do it that way
Yeah.
on some of those if they're simple?
Yeah. Yep.
Okay.
Yep.
And then, but once they get into the business world,
Yeah. And a lot of times people will
so
try to
many-
do their own until they start a business and they know it's going to be too complex going forward.
Mhm.
So that's when you'll start to see that jump.
Yeah. Okay. That makes sense. And I still see some that are self-employed that will try to do their own, but I think like if you're not studying all of that stuff, like the stuff we just talked about today, if you're not studying that stuff, you're just going to leave a bunch of money on the table.
Yeah. And personally, I spend more money than my clients do on tax education.
Right.
So,
I hope so. Yes.
Yeah.
All right. It makes
So,
sense, right? They're not
yeah.
going to. You're right. Like that's
Yeah.
your world. And so
Yeah,
you're right.
I spend way more than my clients do on tax education. That's because I want to be able to provide that to you.
Yeah. Yeah. I love that. And then you're able to give that to them and save them money.
Yep.
Okay. Awesome. I love it. Such good information. I appreciate you for coming on. How do people find you?
Yeah, so I go by the name Tax Cipher. You see me wearing my hat. But we're actually making 2 divisions where we have the real estate accounting.
Okay.
But then I'm also Nelson Business Advisors where I do a lot of my tax preparation.
Okay.
And so what we're trying to do is separate that out because we want to start having people have really clean books and records. Because how do we do tax strategy if we don't have up-to-date financial statements?
Right. It makes it harder for
Makes
sure.
it super hard. And so you're just guessing, see, in order to do tax strategy, you have to have everything dialed in. We really need to know what the numbers are. What are the tax savings going to be if we do X? And so we're building out that website right now with my web designer. So we're getting the Nelson Business Advisor is going to be the tax strategy.
Okay.
And the real accounting is just going to be the bookkeeping side
and stuff like that. Okay.
Yep.
And then do you just, for your bookkeeping, it's like a monthly thing or something, and they send you the statements or whatever, and then you'll go through and make sure everything is done the way it needs to be.
Yeah. So what we do is we look at, how many transactions are going out of your bank, your credit cards, how many bank accounts you have set up. And then we come up with a formula for a monthly price. So we prefer a monthly subscription of bookkeeping versus you giving us everything at year end. Just because January to April 15th isn't enough time to do your bookkeeping. I got to do tax returns. But then if we get into June, July, August of the next year and we got to try to figure out what those expenses were from a year ago, you can't remember what they are.
Yeah,
what they were.
Hard.
And so we want people to be on a monthly subscription for the bookkeeping. Okay. Then we can take that data, the bookkeepers can send that data over to me, and then I can do my tax planning around that.
Okay.
So, but we get way more into depth. I work with a very strong asset protection attorney. Okay. So it's not only, we can save all the taxes that we want in the world, but if we don't structure everything for asset protection and we lose it overnight, then I would be heartbroken. So I truly do care for my clients. I probably lose more sleep than they do, with taxes. But we got to just build your team out. Who's that asset protection attorney that's on your team? Who's the
Are you meaning as far as like, the LLCs and the different layers and stuff like that, or is there more to it that you're referring to?
Yep.
Mostly that. Okay.
Yep. So when I work with my asset protection attorney, he wants to make sure everything is protected from the legal side. And then we have our client, and then we have me, and then the three of us work in a triangle together as a team. Okay. Where a lot of times, your accountant or taxpayer might say, go set up an LLC. The attorney goes and sets up that LLC, but never works with me on how we should elect that tax designation. And so as I start to work, I like to work in teams. So it's just not you're being sent out to someone and I'm not involved in the loop. I stay in the loop with all that stuff with my client.
Okay. Got it. Love it.
So that's a whole nother area of conversation as well. But we do more, I try to be more than just a tax preparer. I really do care about my clients saving tax money, having accurate books. Because what if your books aren't accurate and you go to sell your business? Then you're going to lose money on the sell of your business too. Yeah. Right. Because the numbers aren't there when the potential buyer goes to do their due diligence.
Right. And a good tax repair, I mean, it really saves you, you get back more money than what you pay.
Yeah.
You know what I mean?
Yeah.
Because sometimes we're always just trying to keep things as cheap as possible. And I understand that one. And it might make sense for somebody who's just W-2.
Yeah.
But when you get into this other world, you're not spending the time to understand the tax code.
Yeah.
And you don't have it. You're running a business.
Yeah.
So you need to find somebody else that is.
Yeah.
It's like, here's all my stuff and here's how we do it. And
ahead of
time, do it ahead of time.
Yeah. And taxes are fun. When we went back to the opening, like taxes can be fun when you start to understand the rules. Because when you start saving money on taxes, we want you to take those tax savings and invest. And so then you're building your wealth. And so wealth strategy and tax strategy go hand in hand at that point.
Love it. Bryan, thanks so much.
Yeah.
You gave such great information. And I'm sure there's like 20 other things and we're out of time, but there's like so many things there, but I appreciate it. So we will put the link to websites and get a hold of you in the description. So if any of you guys have questions, you're looking for somebody, Bryan's your man.
Okay. I'd love to jam more. If we need to go into one topic a little bit deeper,
we probably should do one like strictly for real estate investors. We have a lot of people that I have a lot of people just in my circle and all that are just real estate investors, like would want to dive deep. Like, what are all of these things? How does it work? All that.
So that'd be fun to just pull up the whiteboard and map it out and draw, just so people can get a better understanding at that point.
Anytime you say, let's do a video, I'm in.
Done. Okay. Well, thank you so much. Before we leave, I actually brought you a gift.
Oh.
So one of my mentors was Tom Wheelwright.
Okay.
He was a CPA, or still is a CPA of Robert Kiyosaki.
Oh, okay.
It's the win-win wealth strategy. 7 investments the government will pay you. Pay you to make.
So. I love it. All right. Awesome. I'm going to take a look at that. I appreciate you. Thanks so much, man.
You're welcome.
You're awesome. You're just an awesome human. I appreciate you. And this was really fun. So we'll see you guys.
Okay. Thank you.